Hello everyone, this is Paul from the Pin Academy, and in today's video we're going to be looking at how you can easily and profitably and consistently trade synthetic indices. Now, synthetic indices are on the rise in the whole world with its broker, which is Deriv. It's only one broker that you can use to trade synthetic indices in the whole world. Its broker is receiving over 7 million visitors per month. There is no broker, according to the research that we have done, that has those number of users. So in case you want to trade with Deriv also, please first get a demo account. I'm going to leave the link in the description. So this broker is on the rise because it offers something that no any other broker in the world tries to offer it. Of course, other scam brokers have tried to come up and emulate what the broker offers, but it's only one broker that offers it, right? Now, we're going to see how can you profitably trade the synthetic indices. And what are we going to be looking at under that? We're going to be looking at what they are, because most people tend to misinterpret and misunderstand these synthetic indices. Then two, we're going to be looking at the categories that are under synthetic indices. Then also we shall look at advantages and disadvantages to trading synthetic indices. Then also we shall see, I will give you the step-by-step guideline, like how we normally do it, on how you can correctly trade synthetic indices. They are my favorite personally. I trade them more than the currency market, more than the other normal markets, forex, commodities. I trade synthetics more because of the advantages that we're going to be looking at in the video. So make sure you sit tight, get your cup of coffee, and watch until the end so that you don't miss out anything. If you want to be profitable in trading synthetic indices, please watch till the end. Do not skip any part, right? So let's kick off with the question that or the dilemma that most people have about synthetic indices, especially when it comes to one category of them. Which one is that? That is the VIX versus the volatility index, especially V75. There are very many articles out there and very many things that have been written that these things are the same. These things are not the same. Please keep it in your mind, right? Now, what is the VIX? This is the normal VIX that everyone knows. All the other traders know. Those who trade the normal markets. Now, this sometimes is called the fear indicator, right? This VIX here, this is the normal VIX. It's just written as VIX the way you're seeing it on the screen here. While these ones are written as volatilities. Now, the VIX 75, which people normally, or what you can call volatility 75, which people normally compare to this VIX, is different. We're going to look into that. This one's written as volatility 75, sometimes abbreviated as VIX 75. That's what confuses people. While this one is just VIX, and I've told you it measures the fear in people trading. It measures the fear in traders, and also it measures the volatility in the market. Are we together? So it's directly proportional to how traders are doing. What's the fear in people? For example, if the fear is very high, the market is most likely going to drop. If you see this VIX going very up, the prices are most likely going to go down, especially in the stock markets and the normal indices, the stock indices. By normal indices or stock indices, I mean the NASDAQs, the S&P 500s, and the rest, right? So we saw VIX during the pandemic and even just of recent year going up to the 30s. And you clearly saw how the stocks were doing. Stocks were crazily dropping. Of course, I'm not saying they've found the bottom yet, but at least this is what I'm trying to explain, that this is what VIX stands for, which is different from this, right? Now, what about this other VIX here? These other volatilities, which we abbreviate just as VIX 75, there are very many. VIX 75, V50, V10. There's also volatilities 1S, 75 volatilities, like that. Now, these volatilities are man-made. These volatilities are not real. They're not measuring anything. Rather, they're just copying the behavior of the real markets. That's why they're traded 24/7. They're not real markets. These normal markets are traded during working hours of the banks. Most of you don't know why the market operates. The normal markets operate Monday to Friday. It's because that's the time or the normal operating hours of the normal banks, right? In most of the countries, 9 to 5 p.m., right? So depending on in each country, it doesn't matter whether it's GMT +3 or GMT +2, right? As long as your bank is open, that's the opening time of the markets in that country. The same applies. That's why you see there is New York session, Asian session, European sessions, because that's the time the banks are opening. Now, these ones operate 24/7 because they're not operating on the normal market, right? Of course, they follow price action. There's price involved, but they are not emulating anything. So they're just copying the behavior of the markets, but they're not being handled by any bank that they're running on the behavior of a certain bank, or because a certain bank is open. No, right? They are just independent, right? The only thing they do is trying to copy the normal markets. Now, these are the volatilities. This one is only one. But these are the volatilities we're talking about. We have certain categories which are going to be talking about. We have volatility, we have the crash, we have the boom, we have step index, we have range, right? We have the jump. So there are very many categories under synthetics, right? But I just wanted to bring out for you the difference between this VIX and the volatilities, because most of you, even including those who have been trading it, do confuse it, right? Now, let's speak about what are they. I've already briefly defined it for you. These are instruments that copy real market behavior but are not affected by real world events, meaning that the demand and supply that is affecting currencies, commodities like gold, oil, and the rest, right? It's not going to affect this. The same applies if there's fundamental coming out. One of the reasons why I love trading synthetic indices, whether there's fundamentals or not, they're going to be operating as normal. News is not going to affect them. That is one. Then also, they operate 24/7. Even on weekends, you can trade them. Are we together? So if someone asks you what are synthetic indices, this is what you tell them. These are instruments that are copying the real market behavior, but are not affected by world events. And also those who have done sciences, you know that the word synthetic means complex. And what does complex mean? Complex means something that does not exist. It is just imaginary. That's why we're saying it is copying the real market. So this is just an imaginary market, but it follows, of course, price action, right? So what are the categories? We have already spoken briefly about the categories. We have volatilities, we have the crash, we have boom, we have step, we have range, we have jump, we have the baskets. These are newly introduced on the real markets. Of course, there are many other things that are still testing on their demo accounts, but those who trade real accounts, these are the ones that are there. We have baskets, we have jump, we have range, we have step, we have boom, we have crash, and we have the volatilities. Now, under volatilities, there are very many. There's volatility 75, there's volatility 50, 10, there's volatility 10, 1S, volatility 75, 1S. There are very many, right? You'll see them just on the MetaTrader once you get a demo account. Make sure you get a demo account. The link is in the description. Synthetics run 24/7, and I know traders before also discovered the synthetics indices. On the weekends are usually boring, right? Of course, most of the traders have a certain way they live their life. They're usually nocturnals, and also they like staying alone and maybe interacting amongst themselves. So this can also help you take away the boredom to trade on the weekends. Now, we have also crash. We have crash 500, crash 1000, etc, etc. Then also we have boom, boom 1000, boom 500. Now, step index is just alone, our step index. Then we have the range, right? We have the jump, jump 10, jump 50, and the rest. So these are the categories of the different synthetics that one can be able to trade. Then what are the advantages and disadvantages? Let's start with the advantages. We have already mentioned them briefly. You can trade them 24/7, including holidays and weekends. There's no saying that the liquidity today is slow because a certain country is having holiday. Not like the normal markets. When the normal markets are having holidays, especially in the US, those big major countries and that have the major currencies like the US, the UK, and the Eurozone, if they're having any public holiday there, you'll see that there's liquidity reducing in the market, which is not the case here. Then also, it's not affected by fundamentals. I've already mentioned this one here. So you can trade freely without having the worry of fearing that news is coming out and all that. Then you do not need a lot of capital. Those who have traded it, you need little capital, but this one I would not advise that you start with little capital. If it is what you have, it is okay. But if you can afford more, start with more, because they're a bit heavy and volatile. So for you to trade them, actually, some of them are heavier than the NASDAQ. Most of you fear NASDAQ, the normal stock indices. Most of you fear them, but these ones are more heavy than them. They can make money for you, but also they can take a lot of money from you. So you can start with little capital, yes. I've seen people depositing $5, which is the starting point. Before even they used to deposit $5 or $1. But of recent, I've seen they've increased it to $5. I don't know if they'll take it to 10, because most of these things are very, very heavy, especially the V75, V100. These ones can easily clear your capital quickly, right? Now, also they have faster order executions, faster than any broker that I've seen. They execute in microseconds. So if you want to synthetic indices, expect that your orders are going to be executed very, very quickly, right? Now, these are the advantages, but anything that is there that has a good side must be having also at least a bad side. I've not seen anything on earth that only has good sides. At least there is something bad about them. So let's look at the bad sides. The first one is they have fixed spreads, right? Meaning that no matter what, no matter the situation, you have to face that spread, right? Then also there's a difference in the minimal lot sizes, which confuses many traders. right? If you've been affected by this, maybe you comment you tell me in the comment section if you face this problem. For example, VIX 75 may have a minimal lot of 0.01, and then you find another one has 0.005, then you find another one has 0.2, another one has 0.5, another one has 3 lots. Now, these differences here can confuse a trader. You may have previously traded VIX, and then you want to trade, let's say, V50, which the minimum lot is 3 lots, or vice versa. You started with this, then you come and put 3 lots on V75, and you blow your account in seconds. If you face this, you can just let me know in the comment section, but this is a major problem that most traders face. Then also it's offered by only one broker, which I've put the link in the description. Now, what's the disadvantage about being offered by one broker? You know, brokers, they're also in for business. Of course, we know in the normal markets, a broker is linking you to the real actual market. But here, it's being offered by one broker, and we know that since it is just imitating the normal market, it's a complex market, meaning it's imaginary. Meaning there's a way the broker has monopoly over it, and it can do anything, right? Of course, the manipulations are going to be there in all markets, but when a security or something is being offered by only one broker, there's that risk always, right? Of always being manipulated, meaning that in most times they're going to always go in the direction whereby there are few traders. For example, if buyers are more than are greater than the sellers, right? They will go in the sell direction. If sellers are more than the buyers, they'll go in the buy direction. That's why they say that 67% of traders here. Of course, most traders lose money. So they say 67% lose money, but I think this goes to the normal 95% or even more, right? So this is the disadvantage of having only one broker offering this. So these are the disadvantages of that. But now the major interesting part, or the purpose why we have made this video, is how can you trade synthetic indices, any of them, whether you're trading the volatilities, whether step, whether the crash, whether the boom, whether the jump, and everything. These are the steps that you need to follow. Of course, as usual, I'm going to speak about it here, and then we'll go and do it directly on the chat so that you can feel the practical bit of it. The first thing is you can identify the bias. We have spoken about this. The video is just in the top right corner there in that card. You tap in that information card, right? How to identify bias. First, identify the bias of any synthetic instrument that you want to trade. Then 2, you have to mark major levels. This is marking support and resistance in the major time frame. Are we together? Remember, we said we do analysis in major time frames. Identify bias, of course, also in a big time frame. Then mark the major levels there. Are we together? For example, if you're doing daily, if you're doing intraday, make sure you're marking levels in daily and identify your major bias in the daily time frame. Then after that, after marking your major levels, which is support and resistance, right? You have to know how has price closed. For example, if you marked this as your resistance, then the market came down and made this as your support, right? So if the day is here and price is moving, how did the price close? Did it close inside here, or did it close above? Are we together? Did it close here, or did it close above? So that you can make a decision. When it closes above, you know that you're looking for a retest here, then you can look for a continuation up. If it closed within here, it means that there's a possibility that you could wait for it to come down here and then move up to here, or you could wait for it to come here and then move down. So you need to identify the major levels. After identifying the bias, then you need to know or to tell how did price close. Then after that, you can apply your entry rules. Are we together? So these are the steps that you must follow to trade any synthetic index. Please, 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 if you want to be profitable in trading synthetic indices, never ever do your analysis in small time frames. It's going to give you short-term profits. Of course, the same applies to all even the other normal markets, but these ones are more dangerous if you do analysis in small time frames. You will never ever make consistent money out of them, right? I asked last time in one of the previous videos that how many of you have deposited money and kept it on your trading account while making profits, or even if you're break-evening for just 90 days, out of the 360 something days of the whole year. Now, synthetics, if you do not do analysis in big time frames, you will not even be able to keep your money in 1 week. You won't even make a week with your capital because they're very volatile. And if you're making the analysis in small time frames, you'll not be seeing the bigger picture. Yet these actually are following the big time frames, since they're just emulating the normal market. So meaning they're trying to follow price action, but in big time frames, right? And remember, there is no big broker or liquidity provider that wants ask the retailers to make more money than they're making. So they always have to make more money than we're making. And what time frames do they use to trade, to move? They use the big time frames to move. So these are the steps that you have to follow. One, you have to identify the buyers. I've attached a video in the card. Then mark your major levels, and then know how did the price close. Then you can apply your entry rules. These are the exact things that we are going to do on the chart, right? So without wasting time, let's just get straight onto the chart. Okay, so I am on my chart. I'm going to give an example using the volatility 75. This is one of the types of the volatilities, right? So now when you open your chart on any synthetic index, not just volatilities or crash or step, any of them, you can see I have most of them here, but any of them, if you open your chart, what I usually first do is to get sure that to make sure that I know what the market is trying to do. I start usually from monthly to get the direction. So what I'm going to do is I'm going to identify that what is the market trying to do, or where is it supposed to go. So we have this previous low here, and we can clearly see that the market broke this turning point and also broke this turning point. So we also have to mark them. Remember, you can mark using slabs or line charts. So I'll mark this, and I will mark this, right? So then I can go back to the candlestick chart. Now, when the price approached these areas here, right? Of course, we expected price to come and retest this broken level, which price did, right? But it manipulated a bit, like I said. You need to analyze these things in bigger time frames. Now, someone in small time frame, many people lost money because they were trading within these weeks when the price approached here. Of course, in small time frames, these are candles in real small time frames. So make sure you're marking your levels in big time frames, and then you will be able to see the bigger picture. Now, once I leave monthly, I know that I'm supposed to look for buys, right? Of course, the market made a low, lower high, then it made a low. So currently, we're also breaking above this. We're also above this turning point here. So I'll mark it. So this is where we are currently. Now, I'll drop down to weekly and observe what is weekly trying to tell me. Is it trying to give me the same perspective as the monthly? Now, weekly, you can clearly see we're trying to form an inverse head and shoulder, but it's not yet complete. Let me just change the color here so that you can see clearly. It's not yet complete. You can see this shoulder, like the head, and then it's like trying to create a shoulder, but it's not yet complete because the market can still pull back down before going up. Now, weekly, we all know that weekly is the time frame for swingers. So if you want to swing, you have to make sure that this neckline here, area here, is broken before you can wait for it to take your trade. Remember, monthly is telling us we are looking for buys. We have already broken this. We're already above this level here in monthly. We don't know if we are going to close above. The moment we close above, we shall be looking for buys. But you do not just look for buys like that, right? Now, having known that weekly also is trying to create a bullish momentum, what about intraday? Those people want to trade every day. Then I'll come to daily and check how did the market close. Also, I'll decide to identify some lows and highs in in daily. So I'll mark this level here. I have this turning point. I'll change the color to blue, right? I'll change the color to blue here. Then also I do have this turning point here. The blue levels are for daily. The black ones, I've marked them in monthly. And also this blue slab, I got it in monthly, right? So this black line also aligning with the daily level here. We have this turning point here. So then I'll go back to candlesticks. Now, this is how I usually trade. Now, I know that if I do intraday, I'm going to trade between this turning point and this turning point. Remember, this one is aligning with, let me just mark this one also. It's aligning also with daily and weekly, this area here. So I know that if I'm doing intraday, I'll trade between here and here. This is the advantage of fast marking the levels in all time frames. If I'm doing weekly, I will know that I'm waiting for the market to either break above this level so that I can continue up with it, or I'm waiting for it to give me a pullback, at least one of the weekly levels. This level here also has a turning point in weekly around here, or the black levels. So you have to mark and identify your major levels. Then you have to know how did price close. For example, intraday, this is intraday. Yesterday, we closed in between here. You remember what I told you? If we close in between, you know that either we are going to touch up, then we come down, or we are first touching down, then we go up. It's exactly what the market did. And you remember, at the entry time frame is H1 if you're doing daily, right? If you're doing intraday, sorry. Now, what happened? You can clearly see the market touched up here yesterday, but it closed in between here. This is where the market closed. The dotted lines are the separators. So remember I said you'll wait for the market to either first go up, then come down with it, or you wait for it to come down and then you go up with it. That's exactly what the market did. The market came down, you can see it lost momentum here, right? And then went up. So of course you can either decide to enter the price from here, or you can refine this entry from down here, depending on the entry rules that you use, right? So when you go down to the lower time frames, you clearly see that the market broke this low and also came and broke this lower high here, making this our entry area that you could have used. Now, synthetic indices are very, very heavy. Just a small movement. This small movement here is it's having very many pips. Now, let's try to take a look at this movement. How many pips did we make? Let's assume we took our entry from here. How many pips just to this level here, right? These are 900 pips. If you held up to this standing point here, that's 1,279 pips, which is way more enough than an intraday trader is looking out for. Are we together? So always make sure you mark your turning point, then you know exactly where the price is going. Let's take another example at let's look at a V25 1S. Now, as usual, you start from monthly. Now, when you look at monthly, what do you expect? Now, we do have an M in monthly here. And also, remember, we have spoken about M several times. After an M is made, what do you expect? You expect the market to come back to neckline, which the market is doing right now, right? So you can mark your neckline areas and you expect the market to come to that. And in this case, the neckline area is this one here. So we're going to mark our neckline area just like this, right? And also we have a confluence of the fib. So we have this impulsive move downwards here. So we can mark the market is already above this fib level. So I'm going to mark this fib level here. I'll change the color to black. And then we have this fib level here. And then also I have this fib level here. So these are the ones I'm going to be focusing on. So when the market reaches either this blue neckline here or one of these black levels, I'll be expecting the direction to be bearish. Within this area here, I'll be expecting the direction to be, in this area here, I'll be expecting the market to give me a push down. Are we together? So that is it for monthly. I know where I'm targeting the price from. Now, also when you come down to weekly, what do you observe? You observe that the market broke this structure. All of them were broken. And then we have an impulse downwards. So here also you want to use your fib level. So when I bring my fib level, you can clearly see that now the market is approaching the 50% level and the 61% level is just slightly above here, right? So I'm just going to wait for, meaning that weekly and monthly are speaking the same thing. So I'll just wait for the market to approach my areas, right? I'll just adjust this to accommodate the weekly Fibonacci retracement level. So this is the major area that I'm targeting out for, this area here. So weekly and monthly are speaking the same thing. What about daily, right? So weekly, let me see, weekly currently, also we have this level here. I'll make it red, which the week is closing today. Remember, synthetics operate 24/7. So if the week closes above here, just where it is, you can wait for a retracement to this level and then you can buy back up to here. Now, what about daily? Now, daily, we can clearly see that the market is approaching this area here, but with a low momentum. You can see it's struggling to reach up here. Not like this one here. You can see the movement here was okay. Lower low, lower high, lower low, lower high, equal lows, and then lower low, lower high. Look at the steps here. They were big enough, but look at how the market is coming up here. Not so strong enough, right? It's struggling with a lot of rejections being downwards, right? So we want to observe how price is going to reach in this area here. Then we can look for our trades downwards. Are we together? So currently, these are your waiting areas, right? You can clearly see the level marked in weekly. Yesterday, price acted on it. Now, currently, we are above. So in this case, what are you going to be doing? You're going to be just waiting, right? You're going to be waiting and seeing. Now, here you can apply your entry rules. If you want to use a trend line, is it broken? It's not yet broken. So you wait a bit on it, right? If you're using levels, lower lows, lower highs, it's up to you. You can decide to wait for your rules to be fulfilled, then you can trade. Now, any person trading in smaller time frames will not be able to see this. You know, smaller time frames have a lot of noise. And like I've told you, these synthetic indices are very, very, very volatile and very heavy. They can easily clear your account in no time. Are we together? So you can clearly see here the market was ranging, but if in big time frame, you can clearly see it's in an uptrend. Now in a smaller time frame, someone will be seeing ranges, short term. They will think that a downtrend has started here and then the market continues up. Again, they will think a downtrend has started here, the market continues up, right? At least in the normal markets, they are not so volatile and they're not so heavy. So even if you do analysis sometimes in smaller time frames, it's okay. But in these synthetics, whether you want to do intraday or whether you want to scalp, make sure you're following these steps. Mark your major levels either in the big time frames. If you're doing intraday, remember we know our time frame is daily for intraday. Are we together? Then if you're doing swinging, we know that our time frame is weekly. This one is for swingers. Are we together? Then you know that the entry for daily time frame traders is H1. You can refine in minute 15 and minute 30. Then weekly, you know that you're taking your entries in H4 and you can refine in H1. So just follow these principles and you'll be able to trade any synthetic index that you do wish to trade. So that was it for this video. I hope you guys got value out of it. If you did, do not forget to give it that thumbs up button. And if it was your first time coming across our channel, make sure you click that subscribe button. That's it for today.